All right. Hope everyone's having a good weekend. Hope everyone had a good week last week. For today's video, I'm just going to go over a little concept on how to read candle price action, how to align yourself with institutions, how to tell what the algorithm is doing when it comes to filling orders, which orders it's tracing to, what kind of high probability price action are you looking to trade, these kinds of things. So basically, it's really simple. You want to look for displacement. A displacement is the big thing in good price action. So basically, like if we go to MS Paint, I want to do a little abstraction here. So if we have some liquidity, let's say we have some level here, right, and we have some buy side liquidity resting up here, okay, and we have some level down here and we have sell side liquidity resting down here. And let's say that there's not a lot of liquidity in the market in between here. So this is kind of there's not a lot of there's not a lot of people placing orders as price moves from one liquidity pool to another. So this is why old highs and old lows get displaced too, right? So this is some old high and this is some old low, right? And there's some price in between whatever. Since these old highs and old lows are liquidity concentrations, that's why the algorithm wants to track towards this. Because remember, there's liquidity everywhere in the market, right? Like we can have a little uptrend here, and there's liquidity, there's orders all up and down this price action, right? There's not just liquidity at old highs and lows. However, there's liquidity concentrations at old highs and lows, which is why you can use those as draws on liquidity. Now, because in favorable market conditions, there's going to be more liquidity at the highs and lows and less liquidity in between everything. So price is going to want to quickly displace down to these lows and then displace back up to these old highs, right? And that's going to look like we're going to have price action with big bodies. We're going to have big bodies, small wicks, right? Small wicks, and we're gonna have fair value gaps, okay? So big body, small wick here, we're gonna have fair value gaps. And that's displacement to liquidity. There's gonna be liquidity up here, and we're coming from liquidity down here, okay? Conceptually speaking, that's kind of what we're looking at here. And this means that there's liquidity concentrations at the highs and lows, and there's not enough liquidity to create big wicks on the inside of the market. There's not a lot of orders being filled on the way there. This is favorable price action. This is high probability. You can expect price to behave predictably according to the theory concepts of the algorithm, right? When there's liquidity concentrations at the old highs and lows, and there's not much liquidity elsewhere in the market, the algorithm just wants to seek out those auto highs and lows, and the algorithm will move to very predictable places in order to fill orders. Conversely, when we have some level here, we have some level here. Sometimes there's going to be a lot of liquidity. There's going to be a lot of orders being filled, a lot as we trace back up. It's usually going to be a slow trace up because the algorithm isn't driven super fast to these high volume of orders here because there's such a high volume of orders here as we go up the path, right? Essentially, when we see on days like this, like for example, on a big sell-off day, like we had a couple of those recently where we had a huge sell-off and there's a lot of orders being filled, a lot of people being liquidated, a lot of people placing orders to try to get in on the sell-off. There's going to be a lot of wicks and there's not going to be a lot of displacement. It's kind of hard to trade. So you can kind of see it as it's happening because you're going to be watching price is going to be moving kind of slow, but it's always going to be moving in the same direction, and there's going to be a shit ton of wicks. Okay, so I can't really find like a good chart example right now because I didn't have one prepared. Essentially, the idea is instead of having the gaps in the price action, you're going to have smaller bodies and really big wicks on either side, and the bodies are going to be pretty tight together. There's be wicks covering both sides, right? So there's no gap being created here. That is not price action that you generally want to. I mean, at least it's not good price action for how I trade because while it's predictable and you just think retrospectively, you're like, yeah, dude, just market short would have gotten me, 500 points. But it's hard to trade that price action because it's not acting in a way which can be read based on the algorithm. And the only reason that we're able to take any trades in the first place is because we are able to read what the algorithm wants to do, and we're able to predict it based on that. And if you take a trade on a trendy day like that, where there's a lot of liquidity and shit's moving slow, you're basically just guessing. So you're guessing that it's going to continue. For example, I mean, this week actually wasn't great, but if we go to last week, or like right here is a pretty good example. So this is good price action to trade, right? We have some liquidity concentrations, data highs and data lows here, a lot of sell side right here, of course, and we have a lot of buy side up here. Okay, this buy side gets swept, right? And you can see when we open, we displace through this buy side. Okay, that means that there's less liquidity in between in this little range here. There's less liquidity in this range, and we're tracing to a lot of sell side and buy side above these old highs and lows. So we displace above these highs, and then we displace back down across these lows after a little hesitation candle, right? There's a lot of liquidity being filled on these wicky candles like this. What happens, right? We know instantly that there's concentrated liquidity pools at this wick and this wick low and this wick high, right? So we're looking to have a lot of orders resting up here to begin with, okay? Now we see displacement up and to fill these orders. And then we see this hesitation candle, right? We see of this liquidity candle, there's a lot of orders being filled, there's a wicking out both sides, and it kind of hesitates. And then what do we see immediately after? Displacement back through to the downside. Now, this would have been a perfect entry for me if we had gotten the inversion up around here, but since we inverted underneath this candle, my only entry is a pullback here, and we didn't get it, so I just had to watch this sell-off, which was really sad. But in order to align yourself with how the institutional orders are going, you're going to want to look for displacement and look for displacement out. So that's kind of what the whole premise of the IFVG strategy is you want to see displacement in one direction to take out liquidity and then see displacement back through immediately after, and that's going to give you a really good sign as to where price is going. And so if you're just if you're just looking at the charts, you're not looking like you're just tapering the charts, you can tell where the market's going to reverse, where the market's going to go by noticing how it reacts to certain liquidity pools, right? So you would at a glance maybe say, okay, well, we just swept these data lows, and let's say you have a bullish long-term bias. 4-hour chart is bullish as fuck right here, right? We're just inside this fair value gap. We expect to react upwards, continue back to these highs, right? So if we go back to the 1-minute chart, you can logically expect to react strongly off these data lows. And so because we're continuing bullish, and so maybe you're looking for a trade after we sweep these lows. See how we displaced through these lows. There was concentrated liquidity, and then now what do we have? We have a lot of wicks here and not a lot of displacement, which means that a lot of orders are getting filled. There's a lot of liquidity in the market right here, and it's not really doing anything, right? These wicks, you can't just trade these wicks like that. You should wait when you see this price action, right? You have to wait for confirmation of the algorithm pushing price back out of here, right? If price doesn't displace out of this level, then we have no reason to believe that it's going to continue in that direction. This one gets inversed, and maybe you take this and this is a loss, but there's signs that this isn't really a proper reversal, because on these quick reversals at these levels, you're not going to get a lot of lows left behind. You're going to get like we saw on the example up here. There's not a lot of liquidity left. We take it decisively, only create one high, and then we push back down. Here we've left equal lows. We have a lot of lows on the way up here, and so this inversion is very sketchy. This is just a fake out. So you can read this fake out because since we know that these wiki candles are a lot of liquidity, even though it may not be directly obvious because we don't have something as strong as a data high or low. So as you can see, we take this inversion, it ends up being a fake out, you get stopped out, and it absolutely fucking decimates these lows. But then what happens here? We take these lows out, we displace all the way down here. What happens? Boom. Straight back up. Nice displacement back up here. And notice what happens here. We only left one low. And generally speaking, usually on these reversal patterns, to trade back up off a level, you're gonna get two stabs. You're never like unless price is really efficient and you sometimes you just get one stab, but that's very rare. You're gonna want to look for two stabs to fake out and grab the liquidity on the fake out. So now we displace back through it again. We have a lot of displacement in this direction. So that's your confirmation that we are indeed continuing back up as we thought we would. So overall, once you understand displacement, you can understand order flow. And once you understand institutional order flow, you can cut yourself out of a lot of losing trades just by understanding that the market does not necessarily have to go in the direction you think it's going to go right away, and you should look for signs that the algorithm is pushing price in that direction before you actually take a trade. So we should wait for price to clarify by not having a lot of wicks, by having displacement, by having clear concentrated levels of liquidity that price wants to draw to, aligning that with your daily bias, and you can get a really nice trade. Like I bet you on the 3-minute chart, this looks like the kind of trade that would have a nice 3-minute chart. Yeah, see on the 3-minute chart, you get this inversion, absolutely fucking beautiful 170 points. Like there's barely any red candles on the way up here. You can catch absolutely beautiful moves like that. So this is the kind of shit that you want to be looking for. Hopefully this helped you. Hopefully this gave you some insight into how the algorithm reacts to institutional order flow. Hopefully you guys can use this to help you in your trades, and I will see you later. Peace.